Stock market crash. The U.S. stock market is experiencing a notable decline recently, which has raised the fear of possible stocks market crash. $5 trillion wiped out. Tech giants like Tesla and Nvidia collapsing 15% in a day. AI stocks are in a full-blown bear market, down 30% since January. Is stock market crash in the offspring? But here's the twist. While everyone's panicking, a hidden sector is quietly surging. Energy stocks like Exxon, up 20% as oil hits $80. History's repeating itself. Before the 2008 stock market crash, the smart money rotated into undervalued sectors before the storm. Right now, Morningstar says small caps are trading at an 18% discount, the biggest opportunity since the 2022 crash. Part 1: Factors contributing to the stock market decline. Tariff uncertainty. A significant driver of the recent volatility and decline is the uncertainty surrounding the impact of tariffs, particularly those proposed and implemented by the Trump administration. Concerns are rising about potential trade disruptions and retaliatory measures from key trading partners. President Trump has referred to April 2nd as a Liberation Day, when new tariffs are expected to be implemented. Inflation concerns. Despite some hopes for easing inflation, recent data indicates that inflation remains sticky. The core PCE price index rose to 2.8% in February, exceeding forecasts and the previous month's reading. This raises concerns about potential stagflation, high inflation, and low growth, and limits the Federal Reserve's flexibility for interest rate cuts. Weakening consumer sentiment. Consumer confidence has been declining, with the University of Michigan's consumer sentiment reading for March hitting its lowest point since late 2022. Long-term inflation expectations have also risen to their highest point since 1993. This weakening consumer mood suggests a potential slowdown in spending, which could further hinder economic growth. Recession fears. The combination of tariff uncertainties, persistent inflation, and declining consumer confidence has led to growing fears that the U.S. economy could be headed toward a recession. The drop in the U.S. 10-year Treasury yield, which fell to 4.25% recently, often signals rising concerns about the economy. Rotation from growth to value. There's been a noticeable rotation in the market, with value stocks outperforming growth stocks. This suggests investors are becoming more cautious about high-growth companies, particularly in the technology sector. AI-related stocks have also experienced a significant downturn. Earnings expectations. Some analysts believe that Wall Street's earnings expectations for companies in 2025 might be overly optimistic, especially considering the potential for an economic slowdown. Part 2: Trade wars and tariff impacts. A trade war or significant political decisions can act as catalysts for a stock market crash in the U.S. through several interconnected mechanisms. Increased costs and reduced profits. When tariffs are imposed on imported goods, U.S. businesses that rely on these imports face higher costs for raw materials and components. This can squeeze their profit margins, leading to lower earnings and potentially a decline in their stock prices. Retaliation and global trade disruptions. Trade wars often involve retaliatory tariffs from other countries on U.S. exports. This can harm U.S. companies that sell their goods and services internationally, reducing their sales and profitability and negatively impacting their stock values. Supply chain disruptions. Tariffs and trade barriers can disrupt established global supply chains. Companies may struggle to find alternative sources or adjust their production processes, leading to inefficiencies, delays, and increased costs, all of which can negatively affect their financial performance and stock prices. Reduced consumer spending. Higher import costs due to tariffs can translate to higher prices for consumers. This can reduce consumer purchasing power and lead to decreased demand for goods and services, impacting company revenues and stock values across various sectors. Economic slowdown and recession fears. The combined effects of increased costs, reduced trade, and lower consumer spending can lead to a slowdown in economic growth. Prolonged and severe trade wars can even trigger fears of a recession, causing investors to become risk-averse and sell off their stock holdings, leading to a market crash. Example: the trade tensions between the U.S. and China in 2018-2019 led to significant market volatility. When new tariffs were announced or existing ones escalated, stock markets often experienced sell-offs as investors worried about the economic consequences. Conversely, when trade talks showed progress, markets tended to rally. Part 3. Political decisions and policy uncertainty. Sudden and unexpected policy changes. Abrupt changes in government policies, especially those with significant economic implications, can create uncertainty and shock the market. For example, unexpected regulatory changes, shifts in tax policy, or drastic changes in international relations can lead investors to reassess their positions and potentially trigger a sell-off. Increased regulatory burden. Political decisions that lead to increased regulation on specific industries or the broader economy can raise compliance costs for businesses, potentially hindering their growth and profitability and negatively impacting their stock prices. Geopolitical instability. Political decisions that escalate geopolitical tensions, such as military conflicts, international sanctions, or breakdowns in diplomatic relations, can create significant uncertainty and risk aversion in the market. Investors may fear the economic consequences of such events, leading to a flight to safety and a decline in stock prices. Fiscal policy mistakes. Poorly conceived or implemented fiscal policies, such as unsustainable levels of government debt, sudden cuts in essential spending, or poorly targeted stimulus measures, can undermine investor confidence in the government's ability to manage the economy, potentially leading to a market downturn. Political crises and instability. Domestic political crises, such as impeachment proceedings, government shutdowns, or widespread social unrest, can create uncertainty about the future direction of the country and its economic policies, leading to market jitters and potential sell-offs. Part 4. Historical examples. The Smoot-Hawley Tariff Act, 1930. While the Great Depression was multifaceted, the passage of this act, which significantly raised tariffs on imported goods, is widely considered to have exacerbated the economic downturn and contributed to the decline in global trade, negatively impacting stock markets worldwide. Political events and market volatility. Throughout history, various political events, such as wars, major elections, and political scandals, have triggered periods of stock market volatility, and in some cases, significant declines due to the uncertainty they generated. Investor psychology and market sentiment. It's crucial to remember that stock market crashes are often fueled by investor psychology and herd behavior. Trade wars and negative political decisions can create fear, uncertainty, and doubt feud among investors. This can lead to panic selling, where investors rush to liquidate their holdings regardless of the underlying value of the companies, further accelerating the market decline. In the context of the current situation, the uncertainty surrounding potential new tariffs and ongoing inflation concerns, partly driven by political decisions and their potential economic impact, are already contributing to market declines and increased recession fears. If these uncertainties escalate or materialize in a significantly negative way, they could indeed act as triggers for a more substantial stock market crash. In conclusion, trade wars and significant political decisions can trigger a stock market crash in the U.S. by disrupting economic activity, increasing costs and uncertainty for businesses, reducing consumer confidence, and ultimately leading to fears of an economic slowdown or recession.